Hi everyone. Terry has asked me to go over the Euro Yen strategy that I posted about earlier in the year, and I don't remember the specific strategy, Terry, but if you drop me a message and just outline which one you're talking about, then I can go into more depth. But let's broadly, all of these ideas that I'm posting are essentially the same, but it's just the mechanics are slightly different on them. So let me just show you a strategy that I'm using on the Euro Yen at the moment, because it just highlights it highlights some of the big ideas. Okay, now this isn't a suggestion of a particular strategy to follow, but it just kind of highlights some elements that perhaps we know about, but unless they're kind of highlighted, it's hard to take on the ideas, because it's actually a really rational way of looking at trading, but it feels the opposite to that. So let's say that we want to trade with a trend, but we don't think that going into sort of complex ways of trying to measure when a trend is occurring or not adds any real benefit. So what we're going to do is we're going to take like a simple line in the sand, something really simple, and just use that. Okay, so we're basically testing the idea that you need to have a precise measure of when a trend's occurring and then trade, or B, it doesn't really matter, so you might as well just use something very simple and as black and white as possible. Okay, so for this example, we're just going to use 200 period moving average, but you can use any period of moving average. And all we're saying there is we're looking back a certain amount of time, and if the trend is up, then price is going to be above this measure, and if the trend's down, it's going to be below. Sounds really simple, but I think you'll find a lot of momentum strategies use something very similar. Okay, reason being because, like I believe, you can't really predict a trend by accurately by looking at past data, because it's the new data coming into the market that's going to decide whether it continues or not. So the best thing you can do is look for a hint and use that as your measure, if you like. Okay, so once we've determined the trend, what we're going to do is we're going to use the same thought process, the same approach to deciding when to enter that trend. So in other words, we're saying you can't really get the perfect entry, so you might as well use something very simple. Okay, so in this instance, what we're going to do is we're just going to say if price is above the moving average, okay, and obviously if you're awake to trade, I don't know why it's not marked here, but this would be the period of time when I'm sleeping. Okay, so you see it's marked here. Okay, so if we're awake and the trend is long and we get a bar closing in the direction of that trend, then we're going to take an entry. Okay, so if I just zoom in a little bit here. Okay, so we can see the trend is long, okay, and here we get a bar close in the direction of that trend. Okay, so if price continues in that direction, so let's say a breakout of that bullish bar, okay, we're going to take the trade and we're going to just stick a stop under the nearest swing point. Okay, and then if price stops out because price has gone lower, gone more counter trend, then we're going to repeat the process. Okay, and if that stops out again, we're just going to repeat the process. Now, this is really simple, and again, it's going to feel irrational, but let's rationalize it a little bit. We're saying that price is likely to continue in this direction. Okay, and what we're doing is we're trying to buy the best value entry into that trend. Okay, which is going to be as close to the moving average as possible, basically, in effect. Okay, if prices are going to go up here, the best value entry, presuming this is our line in the sand, is going to be down here. So we're taking the best value entry into that trend. Okay, and because we're only using a single bar, we're making our stop as small as possible to increase the potential risk to reward, the potential return. So, really, when you consider what you're trying to do is make more on your winners than you lose on your losers, this is a pretty rational way of doing it. Okay, so now we've got the trend direction and we've got how to enter into that trend. We need to consider this exit point. Okay, and we're saying that the whole point of doing this is that we can make much more on our winners than we do on our losers. So really, we want to maximize this as much as possible. And like the other elements of the strategy, we don't know how far it's going to go. And at the same time, it's assumed that we can come up with some sort of trade management strategy that's always going to be the best. Again, we're going to what sounds rational, we're going to say, well, no, that's irrational, because like we said, we don't know what data is going to come into the market here. And although it looks like all price movement adheres to some pattern that's happened before, it's actually very noisy, that pattern. To our eyes, it looks like all the swings and retraces and consolidations are readable. That's what it looks like, but that's the brain trying to deal with the chaos, with the confusion, with the complexity of what's happening. Okay, so with that in mind, all we need again is some simple way of saying, well, okay, none of these exits are going to be perfect. What's a nice, simple, repeatable way of making sure that they're big, at least the win-loss ratio, the risk to reward ratio is a large one. Okay, so the simplest way to do that would be just to stick a large target on it. So you could say 5R or 10R, or something like that. Okay, that's as simple as you can get, really. Just stick a large target on it, and if it gets there, good, and if it doesn't, then you just chalk it down as another loss. Okay, now the final element you need to consider with this is when do you add another trade? Because if you're in this trade that's in profit here and price continues to trend, you're kind of missing out on opportunities by not adding again, let's say the next day. Okay, so what I said was, okay, well, on these lower time frames, when a trend's occurring, you're likely to get more orders come in and price continue when new sessions open. So the easiest way to deal with that was say, Well, every day, take all of the available trades until regardless of whether you have a trade already. So if you were in this trade here, and it survived through to the next day, and you start again and you repeat the process, trying to get the best value entry of that day into this trend that we're hoping continues. Okay. So, there what you've done is you've really simplified the whole process as much as possible. But when you consider what you're doing, it seems like a fairly rational way to trade. And then the question is, would that sort of simple strategy make profit? Now, I can tell you that it does, but a lot depends on the movement of the market, whether you have enough trends. Because if we look, what's going to happen with this sort of strategy is you're going to get periods condensed together where you make a lot. So when you get a sustained downtrend that remains below the moving average for a lot of that time, you're going to get, say a 10R here and 10R here, 10R here, and maybe a few stop outs. So in periods like this, you're going to make really high returns. Okay, you're still going to take a fair few losses at the expense of securing these best value entries into the trend. Okay, but with your very high risk to reward, short periods like this, you could make 40 or 50R. Okay. But then the downside is that you're also going to have periods like this where you literally just constantly lose. Okay, because price is not trending at all. And by the same measure, you're going to have periods like this where you lose a lot, but you get maybe 1 or 2 winners. Okay. And then it just comes down to a question of, on the instrument you're trading, how many periods are you going to get like this, and what's your return going to be? How many periods are you going to get where you just lose, and what are your costs going to be there? And how many periods are you likely to get where it's just the perfect trend and you just make huge amounts? And, can you expect similar movements going forward? Okay. And a lot of those questions are kind of unknowable, really. But trends are the result of human behavior, and they do happen, much more than you think. And the only way to really develop any belief in that is long periods of testing. And Raymer did a lot of testing on these simple ideas, playing with lots of variables, and his data suggests that essentially having a very high risk to reward is a strong edge. Okay, it's not guaranteed, but his research and what I'm telling you I've discovered is that it's one of the easiest edges to exploit. And really then it comes down to a question of setting a position size conservative enough for you to allow for some sort of turn down in performance going forward, but still high enough that you're going to make the sort of returns that you want. And once you've got that basis to start from, then you can adjust the strategy to suit your needs. So, let's say you did the strategy I just outlined with a strict 10-hour target, and you saw that the rewards were really, really good, but the drawdowns were like 50% or something, and that's too much for you to take. Then you realize it's not necessarily about changing what you use to measure the trend or the particular pattern you use to enter. You need to just look at not shooting for such big returns. So you could perhaps trail your stop at 5R or take profit at 5R. These things are going to reduce the amount of drawdown you get, but they're also going to affect your returns as well. I've explored multiple variations with elements that we believe make a big difference. Okay, so for instance, on the entry side, the simplest one is, like I said, taking the value entry. Okay, so any bar that closes up, you take it and you hold it. If it gets stopped out, you take the next setup and you take the next setup until you catch the bottom of a swing point. Okay, now a more technical approach would be to say, well, okay, look, I'm trying to buy into an uptrend. I want to see a bit more evidence that the trend is up, so I'm going to wait for price to make a higher high and a higher low and break out. Okay, I'm going to take my entry there and put my stop loss down here. Now, this feels, compared to just the value entry, like it's a more considered, more intelligent approach. Okay, and for that reason, it's going to feel like a better entry. But the results don't bear that out. Okay, because what do you save by taking fewer entries? Okay, because if price is just going down like this, retracing back to the moving average, you're not going to generate any entries. Whereas the value one will probably take 3 losses before it gets to the bottom. And instinctively, that reduction in the amount of losses is going to feel like it's an advantage. But actually what you find is, because you end up with a wider stop, you tend to get more winning trades, but price needs to travel maybe 3 times as far to generate the same R. Okay, and what I invariably find is the safer entry, in brackets, or the entry that seems more considered or has more elements lining up, more of the technical elements that we all love lining up, actually makes a lot less profit. But at the same time, you have much less drawdown, you have fewer consecutive losses. It's psychologically easier to trade, but you need to find that comfort zone for you. I mean, do you want to make 300% a year, and can you accept 50% drawdown to do that, or do you want to make 30% a year and have like 12% drawdown? With the correct position sizing, it essentially can be equally as profitable. Okay, we can argue about which one is more risky, but if you put 300R returns in for 3 out of the last 5 years, then you can afford more drawdown than the strategy that's done 30R. So what the point I'm trying to make here is that what appears like a safer entry or like a better choice, it doesn't really make a lot of difference. What makes a difference is having those few elements working together. Okay, so a simple way of defining the trend, a simple way of entering, and a simple way of trying to capitalize on the moves from the trades that are winners. It's just a few simple elements put together, and then a lot of the elements that we see as being really important, like how you define the trend, or what period moving average you use, and how much confirmation you're waiting for. Those sort of things aren't really as important, as long as you have position sizing set correctly, as long as you execute correctly, and as long as the market trends within, roughly about the same as it did in the period that you tested, and you made your assumptions going forward. So the entries I've looked at and tested were the simple value one, and the other one was waiting for 2 consecutive bars, okay, and the other one I looked at was price making a higher high and a retrace and then taking the entry, okay, and they all seem like fairly different sorts of entries, but essentially they're all just each one is just waiting for a bit more momentum before you enter. That's the only real difference. The actual pattern that they make is largely an illusion. So this was a video for Terry, and I don't remember the exact strategy that I had to cover, but essentially any strategies I come up with are based on those simple ideas. And really, if this style of trading appeals to you, then the best thing really, or the thing you're most likely to be successful with, would be to take those kind of simple ideas and make your own strategy. And do your own testing and generate your own figures. And it takes a bit of trial and error. And certainly if you're going for the pretty extreme stuff with like the 10R target and taking entries every day, you really got to switch off to what's happening in the moment. And I'd say with the 10R strategy, you really need to look at a year of results before you're making any assumptions about how well it's going or not, because like I said, it does have long drawdowns. And to give you an example of that, on my 10R strategy in the last 10 weeks trading, I'm currently in a 21R drawdown. Okay, and I've been in a drawdown trading the 15-minute time frame for 10 weeks, so nearly 3 months. And it does, you do get to a point where that doesn't bother you, but initially, if it's not the way you've traded, it's going to really, really bother you, and you're going to start adding more analysis to your entries, and you're going to start thinking, well, this is terrible, I really need to make changes. But you don't have to. And the reason why is because in just maybe 5 or 6 days of the right market conditions, I can make 70, 80R back. I don't like to put a figure on it, but you can make really large returns in a short period of time. So as long as I've got my position sizing set correctly, really the battle for me is executing the entry and the exit perfectly, and then just being patient. And I hopefully I said position sizing. So as long as I'm not risking too much on a trade, okay, then I can weather those drawdowns. And at the end of the year, it's going to make really good returns. Not every year, because some years you just don't get enough of those trends. But the sort of trends I'm looking for, which is essentially, if I zoom right out on the euro yen, periods like this, okay, where it's not really strong trend, but you know, there's going to be 2 or 3 trades in there that periods like this. So you can see the entries down here. You've probably got 1, 2, 3, 4. It's probably 4 10R winners there in a period of less than 2 weeks. So 40 are there. I should also mention trailing stops. With this sort of trading, trailing stops is a really good way of, let's say you've just tested just going for a straight 10R win, but you're not happy with the size of the drawdowns. Implementing some sort of slow trailing stop really helps. And one of my favorites is at 5R I move to break even, at 8R I lock in 5R, and then at 10R I trail tightly behind the swing points. Okay, so you kind of get a blend of 5R to 15R winners. Okay, the advantage of that is you get entries. Let me find I think it was what you do is you give yourself the possibility of trades like this. This was a valid trade in 23rd of May, where overnight price dropped to 15R, over 15R. So you get those trades that go way above, and then there was an entry again in the next day where okay, this one you got taken out on the trail at 5R. It's quite difficult to do because you see a lot of trades that would have gone to 10R that you only got 5R from, and that's going to feel again like a not very efficient way of trading it. But in the periods where price is kind of choppy but moving, you find it's going to help smooth out your returns and your drawdowns. So you know, that is something to consider. Again, you know, as with all of the other elements, really the secret is to accept that nothing's going to be perfect and select something simple that you can stick to. Okay, so I hope that helps, Terry. If there's like specific things you want to go over, or like specific elements of the strategy you're talking about, please just leave me a message. I'm more happy to do another video.